According to supply managers in the 9 Mid-America states, how is the economy performing?
Our economy, the Mid-American economy, it stretches 9 states stretching from North Dakota, Minnesota in the north to Oklahoma and Arkansas in the south. The overall reading bounced to its highest level since July of 2022. In fact, it was 56.1, and that's well above the 47.0 that we recorded last month. So this is above growth neutral after 3 straight months of below growth neutral readings. This was a shocker for me, and it certainly shows up in the inflation number that we'll talk about later. But we asked the supply managers about what they expect in terms of recession. 35% expect no recession, 10% expect solid growth, and the others expect sort of flatlining across the region for the economy, the national economy that is. Here I'll bring up a chart with the Mid-American region there in blue, and as you see, that's the bounce much higher. In red there you see the national economy. That's the national called PMIs, Purchasing Management Indices, and there the U.S. number will come out later on this morning. I expect it to be higher as well. So these are really shocking. I'll call it shocking in the sense that I expected a downturn in the overall readings.
What were the hiring trends?
Hiring was up from January. The overall reading was slightly above growth neutral. I'll call it in the solid slow growth mode, 52.8, up from January's 46.3. Still seeing inability to find and hire those qualified workers, particularly in rural areas of the region. Difficulty again. Finding those workers who have the skills necessary for doing the job. And we ask about entry-level wages, and about half of the supply managers, half the firms reported they were having to increase entry-level wages and to get workers to come in and interview. So that's a challenge for those businesses out there. Approximately 20% indicated that they raised entry-level wages above the rate of inflation. So that's, of course, running at 6%. So entry-level wages for the region in the United States running probably above 6%. That's a growth from last year at this time in terms of entry-level wages.
What inflation trends are you noticing?
Inflation was not good. This is a wholesale price inflation, of course, our gauge in the 9-state region. The overall number went for February 80.6. Of course, these readings range from 0 to 100. 80.6 is obviously showing some significant inflationary pressures. It's also the highest level we've recorded since July of 2022 and is up from January's 74.2, which was also too high for my comfort level. Of course, this just means the Federal Reserve is going to be raising rates on March the 21st and 22nd when the Open Market Committee, the Federal Open Market Committee, Rate Setting Committee, the Federal Reserve meets once again. Keep an eye on the all items included PPI, Producer Price Index, when it's released in the month of March. It's really running about 0.7% month over month. Well, multiply that by 12 and you get an idea of what's going on with prices out there at the wholesale level. Not good, and that's going to be spilling over into the broader economy.
What is the economic outlook?
The outlook, at least our numbers now, are pointing toward sideways movement in the overall economy. In other words, even with the really significant bounce for the month of February, we're still talking about slow to no growth in the regional economy. Residential housing obviously is in a recession right now. We're probably going to record a 6th straight month of declining housing prices, and we're seeing that across the board. And we're also seeing, of course, higher interest rates. I expect the long-term interest rates, mortgage rates, to rise above 7% for the first time in many years. As I said, wholesale inflation is going to be running about 0.7% month over month. That's much too high for the Federal Reserve's comfort. The CPI, I expect it to rise by about half a percentage point from January to February. Again, that's too high for the Federal Reserve. The Federal Reserve is finding this inflationary pressures much too sticky. pushing up prices, and of course they're having to raise interest rates. What's happening here is Social Security. 70 million Americans get Social Security. They got an 8 to 9% raise. Those individuals getting Social Security got an 8 to 9% raise. We're also talking about the federal government. The federal government is within the Inflation and Deficit Reduction Act that was passed by the Biden administration. We're now seeing spending levels and deficit levels that's well above what we had pre-pandemic levels. We're also talking about the Federal Reserve will raise interest rates on March the 22nd when the Open Market Committee, that's the rate setting committee of the Federal Reserve, will raise rates. I expect a 0.5% rate increase. Now that's not what the market's expecting right now. The market expects a 25 basis point increase. I expect a 50 basis point increase. Short-term interest rates as a result will rise by another 0.5 point the next day. That would be March the 23rd. You'll see the prime interest rate rise by 50 basis points, and of course that's pushing up the cost of carrying your balances on credit cards and so on, other short-term interest rates. I expect by the time the Federal Reserve is done, I expect another 0.25% after that. The next meeting of the Federal Reserve beyond the March meeting will be a 0.25%. I think this inflation is going to be tamed, but it's going to be tamed at a higher level than the Fed would like to see. Prime interest rate will rise from current 7.75% to 8.25% on March 23rd, as I said. Keep an eye on the bond market. That's what you need to be watching for. The stock market, not as good an indicator as the bond market, particularly the 10-year Treasury. Mortgage rates rise and fall with the yield on the 10-year Treasury. That yield is probably going to bounce above 4%, and that's not good for those that are borrowing. Keep an eye on the national ISM reading, the Purchasing Management Index for the Institute of Supply Management. That comes out later on this morning. Of course, will release on the first business day of April as well. So keep an eye on that. Also, the price of a barrel of oil. It's been moving between $73 to $75 to $76 a barrel. If it should move above $80 a barrel, that would be problematic for the inflationary readings going forward. I don't think it's going to, but gasoline prices are going to be rising nonetheless. And listen carefully to what the members of the FOMC, Federal Open Market Committee, that would be the governors of the Federal Reserve, the presidents of the Federal Reserve banks throughout the nation, 12 Federal Reserve banks. Listen to what they say in their press conferences. They will telegraph to you and to me what they're going to be doing in terms of interest rates. They're going to be telegraphing for the next couple of weeks what they're going to be doing. It's going to be raising rates on the 22nd. That's it for the month of February. It was a shocking number, but still the reading is still not back to levels we saw pre-pandemic. But again, we're seeing, and it's pushing up inflationary pressures. We're going to see more and more inflationary pressures, and the Federal Reserve is going to be raising interest rates more than anticipated by the financial markets. Until we meet again on the first business day of April, may your economic cup runneth over, and thank you.